from an asset management perspective, when you're looking at a portfolio, people are obviously very familiar with Bitcoin, Ethereum, Solana, all the main different cryptocurrencies out there. There's obviously all the world of altcoins and so on as well. How do you apply then the quantitative analysis in looking at construction of a portfolio and amending it and evolving it over time? Can you walk through, I suppose, on a layman's terms level, how you approach that?
No. I mean, I think it is. I would say there is different layers. I mean, and then let me try to cover some of the layers in a way that I can say that people can hear me or can understand me clearly. So I think the first layer is that I would say that is interesting is that, okay, so what are the benefits of bringing digital assets into a traditional portfolio? Let's assume that you kind of on ground zero, okay? You haven't made your mind with regards to digital assets. So what are those benefits that digital assets can come into your portfolio? Is there any benefits from that? And the answer is that, okay, well, if you go to some of the quantitative terms and the modern portfolio theory, you said that, well, actually those assets digital assets have a very specific characteristics. I mean, so they have a high, annualized standard deviation, so means a definition of risk, and two, that they actually could move in a different way during periods of time relative to traditional assets. And these two features are very attractive, okay? Because if you actually bring something that can potentially have high risk, and at the same time, high risk means potentially high returns, and that's why you think it could be attractive to actually have something high risk. But two, that could move in a different way with the current asset mix that you have in your portfolio, has incredibly benefits because it will improve the way that your portfolio will perform. Okay, so that's, you can measure in terms of Sharpe ratios or information ratios, but that actually will improve the way that the portfolio is actually constructed. Okay, now that's for someone who will say, okay, well, I'm in ground zero. Okay, so bringing let's call it a long position into one of those assets or a combination of those assets, and again go back into another layer. So should you do one, or should you do two, or should you do more than that? Will actually improve, and in some ways kind of move the portfolio that you have into a slightly different efficient frontier, and hopefully that efficient frontier will actually have a more interesting risk-adjusted profile. Okay, now then the second part that you have is to say, okay, well, I'm in the level one, so I move one floor up, and I say, well, actually, I made that transition already. I'd said I'm holding BTC, like the majority of your listeners say, oh yeah, I mean, we bought BTC and we bought Ethereum. We don't have any doubt. We believe that the distribution of returns of those two assets are skewed to the upside. Okay, so we think they're going to continue going higher in terms of price as there's more adoption, as the technology becomes better, as the user case, for example, in the case of both BTC and Ethereum, continue to evolve. So then the question is, okay, well, I mean, how do you get exposure to those? All right. And there's a very simple question to say, okay, well, I would actually hold those as a long position and say buy and hold, okay? Or I will actually say, okay, well, can I actually do some active management around those, okay? And that's, brings another layer, which is very important. And I think in the case of digital assets or crypto in general, quantitative investing is very prone to the asset class, and the reason is because, again, it's a very let's call it it's a high volatility asset that trades 24 hours, 7 days a week. Okay, and potentially have very interesting sort of microstructure in the market. So microstructure in the market is what is actually happened during the day. So you have very big swings in terms of changes and trends because of the high level of volatility that exists and that got embedded into the digital assets. So what I'm saying to you is that, well, if you are holding already some exposure to digital assets within your overall mix of assets, well, actually kind of appointing or having some of the techniques that come from investment management will incredibly improve the performance of that section or that subsection of the portfolio. So now you can say, well, what are those techniques are? Okay, well, one of them could say, well, can we just do, trend following, for example, or manage futures on those coins? All right, so it's a proof technique, quantitative technique that is utilized in traditional assets across multiple systems, and systems means markets. So you do it in rates, you do it in credit, you do it in electricity contracts, you do it in oil, you do it in 10-year bonds, you do it in currencies, you do it in equities. You can do it in any single, pretty much, of the traditional assets. Well, can you actually not do that in crypto? Of course you can. Okay, but you need the skill to actually build those models, those systems that allows you to trade those coins. Okay, so are the coins trending upwards? Are they trending downwards? And so on. So you need that expertise, you need that old infrastructure and the skills to do that. Now, the benefit that brings to those strategies is that they have the ability to as well to take short positions. So now you embed in something that is a technique that comes from the traditional side. You can say for investment management, they said, okay, I'm going to have the ability to short some of those coins when the markets are basically trending downwards. Okay, so not only have the ability to produce positive returns when the markets are trending upwards, but equally as well, just basically to benefit of when the markets are trending downwards. Okay, well, so you can do that, but you need to actually be able to trade derivatives as a means to be able to short those markets. So you need a futures market that allows you to do that has some liquidity, that have some depth, and so on. So, and that's where we are. So as hopefully those examples can be illustrating this, but you go different layers where potentially, adding, let's call it first, digital assets to a traditional portfolio. Two, you make the decision, but you want to actually bring some techniques that allows you to be more effective in the way that the contribution of those digital assets will have into your portfolio. One example could be trend following, the shorting can be another one, would be using, options, for example, and so on.